Welcome to FOMO Investing. I'm Brian.
And I'm Mick.
And we're a podcast focused on investing where we explore the various biases in investment decisions.
And what drives investment outcomes.
The information provided in this podcast is for entertainment purposes only. It is not intended as investment advice, so please do your own research.
Hey, Brian, how's it going?
Hey, Mick. Great to be here in the studio.
In the studio, damn.
Doing our first pod at the same table.
At the same
What
table.
are we going to talk about today, Mick?
We're talking about ANSYS and Synopsys and some merger arb.
So what is that? So ANSYS and Synopsys, these are not CNBC names that you hear thrown around about. Who are they?
The best way I can describe ANSYS, it's actually a pretty old company. It's, I think, 40 to 50-year-old company. And what they do is fluid design. It's, think of it as AutoCAD, but with the 3D physics element.
Right. So simulation software.
Simulation software. And they're about a $2.5 billion in revenue company. Solid software margins, 30% operating margin. Growing very consistently, 10% growth CAGR over the last 15 years. The CEO has grown the company 5x in stock price since he took over.
This is a company that's doing its thing. Nobody's paying attention, but they found a great niche in simulation software and physics simulation, which is what they're famous for. And they do it in various industries. So aerospace, they do it in anything that maybe touches physical engineering. You can think of them as having software in. It's funny. I got introduced to this company when I was in investor relations, 15, 20 years ago. And I was talking to an analyst and I said, what is the most interesting company that you follow? And he said ANSYS. And regrettably, I never really dug deeper into them, but I followed them and never invested. But the market for what they do is very specialized, but I feel like it's growing in importance.
Yeah, no, absolutely. My exposure to them is, so my day gig is transfer pricing, and I review companies all the time, and they've had solid, stable margins for a very long time. Bad transfer pricing comparable, but I've got a little bit of FOMO for not investing in them, since the last CEO.
So set this up. So ANSYS has grown to be a very successful company. And now Synopsys has come in and said, we want to buy you.
Yep. So Synopsys, rumors around the acquisition started in December 2023, right? And they announced the deal January 16, 2024 for a cash and stock acquisition that is still playing out. A deal is not done.
Right. So why don't you describe a little bit more what Synopsys does and why this merger makes sense?
Sure. So Synopsys is electronic design automation company. So the way to think about it is everyone's making chips. NVIDIA would use Synopsys tooling to design their NVIDIA chips. But not just NVIDIA, it's anyone manufacturing silicon chips. There's actually two businesses inside of Synopsys. There's the software that lets companies like NVIDIA design chips. There's also an IP business inside of Synopsys where they give you certain elements. So if Meta is designing their chip, they're using ASICs. There are certain libraries of IP that they own, which they would license.
This is the fastest growing part of their business.
That's right.
This IP business.
That's right. It's about 25% of their revenue currently, rough numbers, but it's growing at a higher growth rate. It's like closer to 20%, 17 to 20%, versus the software part of their business is growing closer to 10%.
Okay, so Synopsys has got a very successful business. They've got a competitor with Cadence Systems, which has about 40% of the market. Is that right?
That's right. So it's kind of a duopoly. Synopsys has got 50% of the market. Cadence has got 40% of the market. between them, they kind of control the market.
Okay. So these are two kind of behind the scenes companies doing their thing, very successful. But why are they coming together?
This is pretty interesting. So if you think about Synopsys, they're designing the silicon chip. And if you think about ANSYS, their design is all around, so like Airbus is a perfect example. But as we sit here, more and more of our stuff, whether you're talking about a refrigerator or a car, has silicon and the material design. And it's actually becoming a lot more important where the silicon is placed, in the refrigerator or in the car, or in the case of NVIDIA, where you've got, there's this thing called multi-die. So you're having multiple GPUs on a board, and it's kind of important how they're placed. And so you want the whole, not just engineering how the GPU transistor works, but how the entire material science and ultimately how the data center is going to work holistically. And so with ANSYS plus Synopsys, the theory of the case, and I think the reason for the acquisition is you can have an end-to-end suite of design from the silicon to the physical element of things.
They each have their own design environments, right? So you have the design environment at ANSYS, which is the physics space.
Flow design,
simulation. And then you have the chip design environment. Right. And so they envision a unified design environment.
Correct.
Which could provide cost synergies that you hope for as a merger and potentially, benefit the company that way. But what they're really focused on, I think, as technology companies, are the revenue opportunities from having this end-to-end design element. And I think that's environment. So do you believe in that strategy? Do you think that's smart? What do you think?
Absolutely. I think the opportunity to have that end-to-end solution potentially expands their TAM, right? You're no longer just selling to NVIDIA, Meta, Facebook, Google on the Synopsys side. And, on the ANSYS side, you're not just selling to Airbus and Boeing. You're selling to the company that's designing a toaster end-to-end, where they've got a chip in their design. And so you're expanding the addressable market in terms of what's possible from the combination of the two.
And I think this is a very forward-looking merger. And I mean that from the standpoint that when you look at things like Moore's Law, which is an observation, not a
Correct.
Physical law, it's happening because companies like NVIDIA and others are finding new and interesting ways to continue to evolve. And I think this is in line with that because these are the tooling companies for NVIDIA and chip makers and others that are in this infrastructure space for innovation and AI and others.
Absolutely. I think they're critical to the success of the next generation of NVIDIA chips. And it's not just the one company, right? I think you're going to see a proliferation of compute. Intel's getting back. There's some news around Intel, but I think you're going to have compute in basically everything. Any consumer electronic is going to have compute, and so you've got the material science and physics of it, and you've got the silicon aspect, and bringing them together now makes a ton of sense.
Well, also, and you explained this to me in a previous conversation, you talk about physics AI, the theory of the case on that, which doesn't exist today, even at the atom level, the quantum level.
Yeah.
Explain the parallel between physics AI and maybe what we understand today about large language models.
Yeah. So if you think about large language models, the basic input to a large language model is tokens, which is text, right? If you think about an image model, something like DALL-E, it's images. And then you've got video models like Sora. The physics model would take the designs that are built in ANSYS, right? So if you're building an engine, if you're a car company, you're building a gearbox, windmill company, you're building the design of the windmill. Implicit in all of that is observations on Newton's law of physics and Einstein's physics. ANSYS CTO was another podcast that does a pretty good articulation of this, is building a generative AI model with this data?
Let me just explain a little bit more of what you're telling me, I think, which is they have this data sets, but they're proprietary to these companies.
Correct.
And there's this idea that you could create an incentive model to share some of that data.
That's one theory that they have.
Synopsys, with this combined company, could be the company that creates the AI to have new and interesting ways of looking at physical AI.
Exactly. So they're both very AI-focused companies, Synopsys and ANSYS. It's not just enabling NVIDIA to build AI, but what does AI make possible for them in their business? Can you build a generative AI, a physics AI? And if you think about that, that would, people talk about what is the next ChatGPT moment. One theory of the case is it's robots. And guess what you need for a robot to navigate around our physical world is an understanding of physics.
And you need that data, and you need to incentivize the collection of data. So you have to have partners, which they already have partners with.
They have customers who are using their stuff, right? Using their software and have captured that information in a way that could be used to train a generative model.
Right. So it's the same idea that maybe Alphabet with Waymo is using real world data to then perhaps understand the physical world better.
Right. But the complexity of it is you've got to aggregate that data, and the amount of pre-training compute, again, you're going to need huge clusters. We've talked about IonQ, quantum compute in a past episode. There's a quantum ML angle here that you might need quantum ML to really process the physics AI.
Right. So ANSYS and IonQ already have a partnership where they're trying to develop some of these use cases where quantum compute can be used for very advanced simulations.
They're testing it out. And, you can tell. So we'll add a link to the Preet Banerjee, who's the CEO of ANSYS. He did a really great pod talking about the technology and what they're doing with quantum compute. They're already messing around with this stuff. His theory of the case is you're going to have useful quantum compute, not like Jensen, but sooner than that. And that might be key to the next generation of ANSYS. I see it as an option. I don't think this is really, you started out, Brian, as, these aren't companies that are routinely featured on CNBC. I'm not on Wall Street Bets, but I'm guessing this is not like a Wall Street Bets topic of the day, ANSYS or Synopsys.
No, well, and I think that's why we're doing this pod, is not just because of the trade, which we'll get into, but I think I see kind of stable companies doing their thing, growing at low single digits 10% or
between the 10 and 20. Yeah, low teens growth.
That have an opportunity very soon to accelerate growth because of the demand for the application layer. And I know we have an appetite for compute, whether that's NVIDIA or if it's quantum computing, we don't really care. It will be digested by companies like this to create new and interesting things, whether it's under the GPU model or some quantum compute model or a hybrid of the two, because we know CUDA's going there with the NVIDIA chips. And so whether or not the timeline is 5 years, 10 years, I don't think it really matters. The appetite for compute still is growing. And this is a layer that I think is going to be a beneficiary of this because of the integrated nature of solving for engineering problems.
Right.
From atom level all the way through to flow dynamics, simulation.
Everyone talks about NVIDIA being the picks and shovels company of the AI revolution. I'd see it combined ANSYS Synopsys as the picks and shovels for the picks and shovels, right? In that they're critical to the design layer, whether the leader is IonQ or NVIDIA or some startup that's yet to be created. They're a critical piece of infrastructure that's required to build the picks and shovels of the AI revolution.
Okay, so let's transition a little bit to the deal itself and then maybe talk about the investment thesis. So you have two companies coming together and it's going to be funded through debt. There's about $16 billion of debt.
It's about half and half, essentially. So
it's a cash and stock deal. And the idea here is that it's going to be kind of a little bit of a couple difficult years to keep the cash flow, to service the debt. But if you believe that these things are going to work themselves out, I think it's going to be fine. I don't see that they're going to be stressed in a way that brings on the additional debt. But any other thoughts on just sort of the combined entity? It will be, both are profitable businesses producing significant amounts of cash flow, but the combined entity is a $100 billion entity.
So when they announced the deal, it was a $35 billion acquisition. Synopsys has traded down since they announced the deal. But yes, it's still in that range. I don't think debt service is a problem. And I think there's going to be real synergies, operational efficiencies in terms of the G&A side of the business. There's going to be operational efficiencies a little bit, maybe on the R&D side. I think they may be going through an investment cycle, thinking about the AI element of things. So yeah, I'm not at all worried about sort of debt service. As you say, these are highly profitable companies. But with mergers, there's a theory of the case that this deal doesn't go through.
So let's talk about that. So merger arbitrage is an investment strategy where you've got two companies, they're doing their own thing. Rumors start to fly. Hey, these guys might get together.
Yep.
The target trades up. We don't know what the price is. And then a deal is announced. And it doesn't trade up to the deal announced price because there's some risk that it doesn't actually close.
That's right.
I find this to be something I, like to invest in. I kind of look for some of these. I kind of look for deals that have a spread that I'm comfortable with. And I sort of have a framework of trying to find things that interest me. And it starts with, is this a quality company? Are you okay owning the target, which you hope will trade up to the closeout price, regardless of the fact that this deal might not go through? And there is some deal premium that's going to be priced in. But your goal as an investor is to say, this is actually kind of market agnostic to own something that will trade up to a price. And there's some likelihood, you don't know, of this thing closing. And they call that the merger spread. So right. How is the stock ANSYS traded in relation to the deal closing and announced over a year ago? So why now? And is this an interesting trade?
The deal was announced January 16, 2024. It was north of 10% right around announcement date, and it traded, the spread got wider. It got as high as 25%, I think, at one point.
I think just over
25%. It's now down to 8%. Why is the spread there? There's real risk. First, shareholders need to approve the deal typically when it's announced. We're well past that. But there's filing which they need to do. It's called a Hart-Scott-Rodino filing, and the FTC can review and say, do we have concerns about competition? They did do a review here. My understanding is the FTC review here from a US standpoint is mostly done. The Hart-Scott-Rodino waiting period is over. So it's mostly approved here. The EU has approved it. Conditionally, there's a little bit of a divestiture that they have to do. The UK has approved it. I think the last holdout here is China. And so the risk, that China may obstruct the closing of the deal. But the reason you have these spreads is it's not a sure thing, right?
Right. But we can take financing off the table, which is sometimes a concern in these deals.
Not a big deal here.
Not a big deal. So we talked about the balance sheet and impact. So we're investing in ANSYS because it's a quality company. We are comfortable with the spread. And I kind of think that these things either, like if it's a small micro-cap company that's getting bought for all cash, you might see almost no spread when the deal's announced, and it might close within a couple of weeks.
Because there's not an FTC review concern. And it's easy.
Like our pod on Checkpoint, which we talked about, where it's going to close in the second quarter. So this has been a year-long or more review process, and an 8% spread tends to be something that has some meat on the bones, but it's not super risky. If you do see deals like 40% spreads or more, the market isn't believing it.
Yeah, there's real risk.
There's real risk. And, I've seen deals where I thought that could absolutely close, that didn't close. My favorite example is Rite Aid. I thought the FTC was completely short-sighted on Rite Aid. They were a retail shop that is a drugstore, and there's endless competition in drugstores, and Amazon wasn't even on the scene yet, and they were worried about consolidation in drugstores.
It's funny you should mention Rite Aid, because that's where my theory of the case about merger arb changed. And my view of merger arb was this was an easy way to make a spread. And that's how I used to invest. I'd invest in okay, there's a 15% spread here. There's a 12% spread here. Not paying attention so much to what were the companies I was buying. And I was in Rite Aid, and there was a really decent spread at some point when I got in. And Rite Aid was blocked, didn't close, lost a bunch of money on Rite Aid.
Well, they also had a lot of debt. And so... and they kept restructuring the deal. I thought, okay, now they've restructured it. They sold off some stores. Now it's going to happen. And still, FTC was behind the 8 ball on this one. They didn't foresee that Amazon, which they did, launched a pharmacy business overnight and is disrupting all the players. Walgreens went private. CVS has not done well.
Yep.
So again, trying to find quality companies. So I would be happy to own ANSYS if the deal falls through. There could be some pressure on the stock if that premium to the buyout fell back, but it was like a 30% premium.
It's a 30% premium. And if you think about what's happened with the stock component of the deal, Synopsys has come down about 11% in value since the deal was announced. ANSYS is not miles away from where it was trading pre-deal announcement. You said buy a quality company, and that's really my strategy shift after Rite Aid is, okay, here's the spread. But what are you buying if the deal falls through?
Right. And there's an important distinction here is this is a cash and stock deal, mostly cash.
About half and half.
Half and half. Okay, half and half. But most of my merger arbitrage experience has been all cash deals because you just get the cash, and I'm evaluating whether or not the acquirer is good for the cash, right?
Or regulatory risk.
Regulatory risk, but can they get the financing? Do they have the balance sheet to do it or on their own? So here, there's kind of two strategies to do the merger arbitrage on ANSYS. One is to say, I want to have an opinion. I buy quality things. I'm going to buy the company, and directionally it's going towards the closeout price, which is cash and a conversion of ANSYS stock into Synopsys stock. The other way to do it is to truly hedge it. And you buy Synopsys, but you're also shorting... you buy ANSYS and you short Synopsys, and you're trying to look for some stabilization of the stock component that's completely hedged.
Yeah. That's where the 8% spread is. So if you buy, I think the conversion is 0.345. Synopsys stock is what you get for one ANSYS stock. So you could buy 100 ANSYS and sell 34 or 35 Synopsys short, and you're hedged.
Do you do that?
I've done that in the past. So getting burned Rite Aid, I've done that. And now I realize that was stupid.
Well, I never do that. And the reason why I don't do it is because I don't think I have I try to keep things simple. I don't know. I try to be directionally correct. I don't try to be hedged perfectly. And I think that's just my investment style. I think if you had a lot of capital and you see hedge funds, that's what they try to do. Find risk-free return as much as possible. And I often find that their hedges sometimes aren't as perfect as they think they are. And I'm not trying to outsmart the world with financial instruments. I'm trying to outsmart the investment thesis from a fundamental standpoint. This is a quality company that I'd be happy to own if it gets acquired and make it in less than a year an annualized return that's actually greater than 8%, right? That's actually how I look at it. It's I try to redo one of these and have some spot in my portfolio for a merger arb deal.
That's my strategy shift post Rite Aid, right? Am I happy owning ANSYS if the deal doesn't go through? And that's really the question, right? Is this a vanity project? You see this in the M&A space where it's bigger is better. And you've got these deals and you're looking at it and you're like, I don't see this growing addressable market. I don't really see any synergies here. So I don't know. What are you thinking, Brian? What's
just taking some lessons from this in our School of Hard Knocks, but also our successes. Because I was in Rite Aid, you were in Rite Aid. But I've done merger arbitrage in a number of deals, and I've done it quite successfully. is I never feel like I need to be early on a merger deal. Like there's always time. And sometimes you actually get a little bit of shakeout before the deal closes. I think when the company puts out a timeline on these things, it's often wrong. It's often a lot longer than you think because the FTC or other approval agencies, they don't need to respond to those market deadlines. It's the market that the management is doing their best effort to put expectations out there. So waiting and watching and being an observer and not trying to swing for the fences on a 25% spread. Like, sure, you look very good in hindsight if you did buy it at that peak,
right?
But trying to get a annualized maybe return on an 8% that closes very soon is actually maybe a better use of time and better use your brain power. But also there's a time value of money component to this because you could be doing other things. Now, what I like about these types of deals in particular are they are market agnostic. So if the deal doesn't fall apart, we could still have a correction, which we see, every 18 months or so in the market, and the deal should hold up unless there's some black swan type of deal where, the banks are all going out of business. I don't know.
But they're not getting the funding or whatever.
Most of the time, these things are going to be market agnostic, for better or worse. Like sometimes it's like arguably Synopsys hasn't gotten credit for some of the AI boom that we've seen. And I'd actually argue that they're well positioned for the next wave of excitement around investment in AI because physics AI is not been talked about enough. I think that's I think it's
underrated.
It's the big market that people are looking for the next large language model type of industry to be invented. I don't know how you make money on it yet or if it accelerates it, but I think that all of the customers are going to need an integrated solution. And whether it's Synopsys and ANSYS coming together, and it's other players that are going to see this and enter the space, they're inventing the market.
Absolutely. Yep. No, I see physics AI as an option, an embedded option in the deal that's perhaps not priced in.
Okay, so let's wrap this up. So this is a FOMO investing podcast. We're talking about a merger arbitrage spread on quality companies that are doing their thing. They're in the tech space. Are you an investor in this company? And why would you be an investor or not?
So yes, I'd invest. Why would I invest? There's a margin of safety here. These are mid-teens growth, profitable companies. And I'm okay owning ANSYS if the deal falls through. What about you, Brian?
One of my favorite investment lessons came from David Gardner, who says some of the most dangerous words in investing is, I guess I missed it. And I've always felt that way about ANSYS, is I guess I missed it. Because this is a compounder. It's doing its thing. It was a $1 billion company when I first started following it. Now they're a $30 billion company. And I knew about it. I knew enough to dig in, and I just didn't. I had it on my watch list, and I was just like, I guess I missed it. And I feel like at least I should get some return and invest at the end here if it goes through. And I know enough about the company that I'm also very happy to own it.
Right.
And they've grown into this diversified simulation engineering company. And when you add an AI layer to this, it becomes super interesting to me. At its end, perhaps, of its story, I think I should own the stock. I don't today, but I'll take a look.
Right. You're happy to own it until it gets acquired, which we think is quite likely given where we're at in this process.
Yeah. So we'll have to check back on this one and see if we actually missed it. All right. Let's go get some lunch.
Awesome.
All right.
This has been fun as always, Brian. I'm Mick.
And I'm Brian. We send our love to our 12 listeners. We'll see you next time.
See you next time.